The idea here is that we do it as in the previous years, as a round robin. So we have the presentation for approximately 10 minutes by the actual stock analyst on the security, and then a colleague, a friendly colleague from a competitor firm will ask constructive questions, hopefully to the enlightenment of everyone. With that, Kim, the floor is yours.
Well, given that I'm from Canada and I've talked a lot about the benefits to Canadian investors from inflation, I thought that I would choose a commodity stock. And there was some debate over whether we would do a gold stock or an oil and gas stock, in the sense of that this community is very familiar with gold, that it made more sense that I do an energy stock. And it's a little bit unfortunate that energy stocks have had a very good move, and they're up at a very high, above long-term historical average commodity levels. So I chose Cenovus, which is one of the major stocks in Canada, as the stock overall. So let me back up to one element. I've covered most of these elements earlier in the presentation I gave, so that I missed out on the fourth point, which is that everyone's familiar with the U.S. market because it's generally about 70% of the global benchmark these days. So it doesn't miss anybody's understanding. But when does Canada outperform versus the U.S.? And if you go back 25 years, Canada has actually outperformed the U.S. stock market. So we tend to flip-flop in terms of when we outperform and underperform. We have a very long common border between the two countries, and our performances are somewhat similar. But when it's more favorable for commodities, Canada goes ahead, and then at other times the U.S. performance goes ahead. But in particular, in inflationary environments, Canada, with a significant commodity exposure, does very well relative to the U.S., especially when inflation is quite rich, above 4%. So there was 5 periods dating back to 1970, and Canada outperformed the U.S. on average by 8%. And that's what we saw in 2022. Canada did much better than the U.S. and a lot of other markets. It was one of the top performing markets in the world because inflation had taken off. And Canada, with a lot of commodity exposure, as is Australia, they have more metals than we do, and we have more oil and gas. And so that, ergo, the selection of company. The other point I'd like to make is, this is one of the slides we've been using in Canada, is there's a great interest in this so-called new economy out there, where you have a lot of data centers being built. With wars going on, aerospace and defense is strong, and then this great interest in electrification to supply power everywhere. And Canada is uniquely placed to benefit from that. We have tremendous resources in our country, and right now the commodity segment of the market is 35% of the index. So it's quite a significant component overall between mining and energy and forestry and agriculture. In energy, we also include pipelines, which have become quite significant in Canada. And then, of course, banking does well. Banking's over 30% of the benchmark. It's typically between high 20s, low 30 weight. And so we have a lot of exposures that benefit in the inflationary environment. And we also have a new prime minister. And with our troubles with the United States, what we considered a special relationship between the two countries has now ended. And there's no longer a special relationship, and we were highly interdependent with the United States. And we've realized that it's important to become less dependent on our relationship with the U.S. And so we're taking much more independent action and developing more and willing to invest more in Canada. So why invest in particular right now on Canadian oil and gas? And we know the commodity price, depending on the day, it's close to $100 a barrel in the US. But Canada has the third largest oil and gas reserve in the world, and we're one of the lowest cost producers. In Canada, the major source of oil and gas is not drilling, it's oil sands. And oil sands is basically a mining operation. Underneath the surface of the soil in mostly the province of Alberta and Saskatchewan, there's large oil sands, which is basically sand with oil embedded in it. And we can use processes to just dig up the sand and then separate the sand away from the oil. And we produce what's called heavy oil, and it's called Western Select Canadian oil. And because it needs processing, more processing to break it down into the components that are useful in the world, it tends to trade at a discount to light sweet crude. And that discount ebbs and flows. And we have refining capacity in Canada, but only covers about 60% of total production. And so a large part of our production is shipped down through the US to be refined down there. And so that's sometimes you get these very fat spreads. So it's very interesting to focus in on what's called the integrateds, the larger companies that have their own refining capacity because they can capture more of the world price of oil than the smaller entities, which are kind of stuck selling at the lower price overall. And so let me move on here. So the company is Cenovus, and it's one of these large integrated, which means that it has both upstream and downstream. And upstream is how you produce the oil, that you own that. But what's a little bit extraordinary is to have the downstream as well, which is your ability to process and refine, and some of them even market it directly to consumers in the country overall. And the benefit of that is that you get a higher net back price for the commodity. So we talk about often in Canada, we have stranded assets. And right now we have significant pipelines, but by and large, 85% of the pipelines in Canada today go directly to the US. So we're really committed to this one major purchaser. Now we've completed the TMX pipeline, and it will take up to about 15% of our production and sell it to the rest of the world. And we can get world pricing if we can get it to the coastline. But we have a lot of ESG issues in Canada and a lot of indigenous populations. And to go from the province of Alberta all the way over through into the beautiful coastline of BC is very problematic and challenged. But now we're more willing to face the music and push through and try and put in more pipelines and more throughput overall, which would help the industry overall. As a value manager, we like to buy things that are cheap. And what you can see here on the bottom of the page here is that we have a PE multiple less than 10. So it's a pretty cheap stock. Now the stock's moved quite a bit in the last couple of years when the commodity price rose very dramatically. But of all the majors, this is the one we chose because it has a fair amount of upside still remaining in the stock, and we're saying it's trading about 25% below its intrinsic value. And given that the market overall is toppy and might correct, this gives us an opportunity to continue to make money in a stock like this going forward in the future. And it's trading at a valuation discount from its peers. It's trading at 4.5 when most of its peers are trading at 5.5 EV to debt adjusted cash flow. So we think there's a lot of reasons why that should narrow, and that gives this stock the opportunity to do better than its peers overall. It also has some of the highest production growth and the highest free funds growth. and has one of the lowest cost structures overall. So that really helps in terms of the net profitability of the firm overall. The interesting thing that's been happening in the energy space in Canada is that with the commodity prices being strong the last several years, there's been a lot of cash flow. And because of ESG, there's been a stoppage, and that was largely pushback from investors themselves to stop wasting money on developing unique new assets out there, especially in Canada. This particular company here, it has a long life reserve. So we've got 28 plus years of proven resource overall. But if you add in the not yet proven, like once you've already got 28 years of reserves, you really don't have to spend a lot of money proving that you've got a lot more. But the probable reserves suggest that at the current production level, there's 140 years of capacity in what they own today. And so they don't have to spend money finding oil. It's there, and it's there for, a fairly significant period of time. And so that makes them unique assets in a sense, that they are the very, very long life commodity assets overall. And oil sands is, relatively easy and low cost in terms of operating and sustaining capital costs. And it's sitting around $21 a barrel. And then in terms of total cost, what would they call the economic costs of bringing a barrel of oil to the market, it's about $43 to $45 a barrel. So, we're going to still make money in the Canadian oil sands operations at Cenovus, even if the commodity price does get this low. And, if you recall, back in 2020, the commodity price fell briefly down to $35 a barrel. It was only the Canadian oil sands that were making money on a cash cost basis. Everyone else was certainly losing money by producing oil back then. The Canadian oil and gas sector is becoming one of the most prolific dividend providers in the Canadian marketplace, which is quite interesting. Historically, commodity stocks never provided a lot of dividends, but now the new focus is to continue to pay dividends and up dividends on a fairly regular basis. This is below the market level of dividend yield in Canada, but for commodities, it's quite juicy at a little over 2% overall. And there's a commitment by this firm that they will, all excess cash at the end will be divided up 50-50 between paying down debt, and debt is quite modest. Debt right now in this firm is $8 billion, the market cap is $78 billion. And the goal of the firm is to get debt down. They think where they should have their debt is down to $4 billion. So between now and getting down to $4 billion, they're going to go 50-50 with excess profits into paying down the debt and paying it out to shareholders, whether it be dividends or share buybacks. And they have been significant actors since 2021 on share buybacks. They bought back 13% of the shares outstanding. So that's created earnings growth as well. So it's a very interesting firm, considered to be a good capital allocator as well. They sold an asset they jointly owned with Phillips 66 for almost $2 billion. And then they turned around, and earlier this year, in the last year, they bought MEG, which is a smaller cap oil company that we did own in our portfolios. We were happy to have that taken out at a premium. And that was about an $800 million investment. And it was very synergistic because MEG's major asset was in Christina Lake, which is where Cenovus is. So there's enormous synergies in this acquisition. They had to fight with a smaller operator and pay up a little bit more to get the asset, but they ultimately won it. So that's my argument on Cenovus. And I just realized I haven't mentioned at all anything about Sionna. So I thought I'd quickly mention that we too are a value shop. No big surprise there. We start with a quant model and move to fundamental. We generally own 30 to 40 names. We have a fairly sizable investment team in Canada. We have 8. It was mentioned earlier that we shrunk a lot, where our business is institutional and retail being mutual funds, which to us is an institutional client. And during the period of disinflation, there was a big movement to growth, particularly institutionally. And so our AUM fell dramatically. And we were 30 employees back then, and we're now down to 15, but we kept our entire investment staff. So it was mostly back office and sales that was suppressed overall in that time period. And we have value characteristics throughout our portfolio. And then just quickly, performance. And if you think that value can't win in this environment, we're showing you a fair amount of outperformance over multiple time horizons, and we've been basically top decile, top quartile against our peers pretty much across the space in most of the funds overall. So let me just stop there. Now, I better bring my notes well, I'll get my notes later. When I take on someone.
So I think we have
I'm being grilled.
5 minutes Q&A. I have like 25 questions, so I'm going to just, the first one for me and for us, I guess, is interesting. Would be interesting to hear your views on oil prices, because what is going on in Iran? Is Iran changing the long-term view or mid-term view that you have on oil prices? And it would be very interesting to hear if you think that it has changed somewhat with the deep cut in reserves, or the big, we're taking reserves out of the world, and on our numbers is more than 1 billion. So what do you think?
Well, certainly 20% of the energy comes out of the Strait of Hormuz, and there's not much going through it right now. And so, and there has been a lot of bombing. So there has been destruction of some capacity out there. Now, right now, I think some people have been arguing, how come the commodity price is only $90 or $100 a barrel, given what is going on out there? But there is strategic storage all around the world, and there has been dramatic, dipping into those strategic reserves around the world, and those reserves are important. And at the first possible moment, you've seen this in history, as you bring down the strategic reserves, as soon as you go, that challenge is over, there's this great push to fill it back up. Now, obviously, they're wanting to do it at lower commodity prices than they're having now, but there is a risk that the two sides clearly are having difficulty coming to an agreement. And I don't think Mr. Trump has a reputation of being a very good negotiator. And so you have two sides that are somewhat benefiting from not having an agreement. And if that continues for a long time, eventually, when the strategic reserves are used up, we could see more spiking of the commodity prices. So we're in an interesting world today. And if you look back historically, people, like when you had the Russians go into the Ukraine, remember that was only supposed to last 3 weeks. And I think Trump, after his great experience in Venezuela, just thought he could go in there and finish up the job in a couple of weeks. And I think he's stuck in something much bigger than he thought. And the Americans, when they went into the Vietnam War, they didn't think that was going to last as long as it did. No one intends wars to last as long as they do. So the risk is if wars continue. But I think the even bigger argument is inflation. And, all commodities benefit from inflation. It just moves with the flow of inflation, so it's one of the few inflation protectors in the marketplace. And through time, we may well see all commodity prices rise, especially when we don't know the level of destruction that's been happening in some of the oil production and the oil pipelines. There's some very vulnerable pinch points in that whole region that could get targeted. So, it's a bit of a bet. Now, in terms of our portfolio, we are roughly market weight again. At these kind of prices, there is a vulnerability to go down. There's a vulnerability not to be there. Right. And therefore, to lean heavily on your actual stock picks. And if I didn't mention it earlier, this is the same in oil and gas as it is in gold. The big integrators, the biggest companies in Canada, they're more stable, steady eddies. They have, less highs and less lows. It's the smaller producers and the explorers that are incredibly volatile and will be very volatile going forward. These are the safer, less risky names to play in. And in our opinion, this stock is the one that has more potential upside in our opinion. I mean, we also own Suncor, which is another major integrated, and a couple of other little plays in the smaller cap names.
So I took the opportunity to ask you about the management. For us, investing in commodities requires to know the management and rank them highly. How do you rank the management of Cenovus? Because they have 3 or 4 projects, Christina Lake, growing in offshore, and also the acquisitions. How would you rate the management? Are they disciplined in the return, or they grow because they want to grow and EPS growth? How do you rate the management, balance sheet management, M&A overall?
Yeah. No, that's a really excellent question. And by the way, I'm not the lead analyst on commodities. Alexei Wojak's at our firm, and he's been investing directly in commodities for 25 years. And he's a super deep dive research guy. You want somebody who's not a generalist. You want them really focused on it, spending time with the management team on all the calls and trips out there. I mean, all of us have done trips. If you ever get a chance to be in Calgary and go see an oil sands operation, it's really quite remarkable. Like just these huge operations of mining, and they keep moving where they mine, and then the resourcing of it. But management is always critical, and Cenovus had a bit of a bumpy past, but it's definitely improved more recently, and it also has some very significant investors. When it bought Husky Oil through a share transfer, which is owned by HK Hutchinson. And so they own a very significant amount of this firm. And they are long-term shareholders. They were in Husky because they wanted exposure to Canadian oil sands. And so by putting it into a bigger quality firm, they're certainly sitting on the board, they're certainly paying attention, as is Capital Group. Capital Group is a major, well-known value shop out of California. They have significant holdings in this as well. Again, very patient, long-term investors think it's a cornerstone of what they're doing overall. So they've got a lot of good strategy and good people on the board, and a management team that's really focused to, drive opportunity and improve their results then that's where this is like the improver relative to the peers. I mean, Imperial Oil is one of the largest oil companies in Canada. It's kind of hidden in Canada because 60% of the outstanding shares is owned by ExxonMobil. And it has 100% of its refinery covered in Canada. So it's very profitable. And so, you have a Cenovus looking at what its peers do better. And you also have Suncor improving what they're doing and being more conscious of costs and not going off on passion projects of finding new oil reserves. Just You got 140 years, why bother doing too much else? And that's what's going on.
Let's focus one more. Last one, I promise. On the risk. Outside Canada, I'm not sure that outside Canada we have the view that oil sands are very polluting, CO2 emissions, big mines, ESG issues, local.
Yeah. Yep.
What do you say? Is it well described outside Canada? Is it a risk that these guys need to pay a lot of certificates, CO2 certificates, that they are, that the government gets there and really not kills, but slows the business?
I'm going to get a little bit political here. We have a big neighbor to the south called the United States. And they like to call our oil sands the tar sands. And they spend a lot of time and money talking about how polluting our, getting at our resources. Well, what about the pollution impacts and environmental impacts of shale? That doesn't quite get the same type of airtime. And Canada is known throughout the world in all of our resourcing is the belief and the acceptance of ESG. Our former Prime Minister was so strong on ESG, he was trying to minimize the oil industry in Canada. So to accuse us of not being conscious and doing everything we can to keep emissions and impact on the environment to a minimum. I mean, what's really fascinating, you go to up to these oil sands operations, like when they're done mining these operations, they restore it, and they're beautiful fields. And they people are very committed to environmentalism and minimal impact in Canada. So I think that's been a bit overdone.
Okay. Well, thank you very much. Thanks, Tim. Okay, I will change my hat. Oops, okay. So, yeah, I'm going to present our value case, Pandora. It's an old friend. The classic has been invested in Pandora for, I don't know, a decade, and we've been in and out. So I will accelerate a little bit. Brief description: Danish manufacturer and retailer, affordable jewelry, as you know, the bracelets, the charms is their main product. It is the world's largest by volume. They produce more than 100 million pieces, 100 million pieces that are handcrafted per year in Thailand. Now they are increasing capacity, I think it's in Vietnam. And they have a scale. They have a scale in design, they have a scale in manufacturing, they have a scale in delivery, in distribution. 15,000 professionals that are crafting the jewelry, so it is difficult to build this kind of cluster, and more than 100 countries, they sell in more than 100 countries. What do we like? Why do we like Pandora on the long term? Because we think they have competitive advantages. This is back to value theory, moats. So Warren Buffett was saying, look for moats. We think they have brand awareness. It's very well known globally. We think they have scale, applied to design, applied to manufacturing, and applied to cost advantage, scale in marketing, scale in distribution. They can do omni-channel, so retail, they can do via the website. They have their own selling channel in the website. They have pricing power, not only because they have low cost, it's because their unit price is very low, which we like. We like when a product of a company is low, we like it. It's a small part of your budget. We like that. And then there's some, not a lot, but switching cost, which is an entry barrier, right? When you buy a bracelet, or your daughter buy a bracelet, then they want the charm, another charm, and this is a little bit of, not network, but you have a little bit of switching cost advantage. I would highlight two of the key advantages: brand, and here there is a comparison between Pandora, Tiffany's, Cartier, and Swarovski. So, brand awareness is very high, and the company is fueling this. So Pandora, as a long-term target, wants to move from charm, low-cost maker to a full-range jewelry, affordable, with global presence. And they are doing that. They are in the middle of the way. And what I was mentioning, the price is low, average from 50 to 300, which is good. It's good to be a low price, low cost in competition. Stock is down 60%. A year ago, it was 1,200 Danish krona. It's now 500, 600. Three reasons: silver prices went up, as we all know. So silver cost, some numbers here, it was 6% of the revenue. Now at $73 ounce, it's a bit lower now, 3 times higher. They can hedge, but they only hedge 1 year. So the impact we will be seeing not in 2026, the impact will be seen next year. CEO departure, this is the other concern, because the CEO, Alexander Lacik, this guy, he's a top guy from my experience, 30 years. He came with Pandora with all-time, a lot of trouble. Channel inventories, design, marketing, everything was wrong. And he came, and in 3-4 years, he took the company to the next level. And now he's leaving. A new CEO is coming, and it's the same team we will enter later on this. And then, obviously, the economic slowdown in the US, consumer US is going to be weak. Then Pandora will sell less. So all the consumer space is being challenged in the US. So this is more a macro concern. And this is important. When short-term things are affecting the name, people think it's going to be forever. So basically what the price now, if you do the numbers, it says that silver prices will be at 100 forever. No, as I can sign. Doubts about the new CEO. Okay, she was the top executive in LVMH, and then in several luxury brands. She's, in the 50s. She's worked with Alexander for I don't know how long. She's the head of marketing in Pandora. The track record is excellent, so I don't have a reason why the new CEO should do bad. And then obviously there is a fear regarding the cost, the silver, and what the company is going to do. I'm going to enter in what the company is going to do. So on the doubts of growth because of the macro thing, or are their collections too old, or they will not grow more, they're going to do 3 things. They're going to improve the design. I'm not an expert in design, is their words. So more distinctive, different designs, different collections. We take it for granted. Brand, they're going to invest more in marketing, that's it, right? Invest more and better in marketing. And as they have the scale, they can do it. And then in markets, they're going to divide the markets by high penetration and low penetration, and they're going to split the strategy. High penetration is going to be more earned media, and low penetration is going to be opening of outlets. So it's not really a big thing, but they are accelerating this. In order to grow, they say high single-digit growth, which basically is 2% new outlets, 2-3% volumes, 2-3% pricing. In my model, I use 5. Which I think is very, very reasonable. The second initiative here, after the, the stock collapse and was not a capital market day, but some kind of what we're going to do, they're going to reduce the impact in silver in the cost. So they are moving from silver to platinum plating. They do gold plating already. And I mean, makes sense. If your costs depend, here you saw the impact is 10 points in EBIT margin, more or less 10, 12 points in EBIT margin that they lose because of the increase in prices if they don't increase their prices. Basically, it's late. They're coming late. The previous CEO, who was an excellent guy, should have already thought we are too dependent on one commodity that moves. So it's too late. Don't do it now, because silver price will come down. But it is still worth doing it, because in the end, you want to be more diversified in cost. So I think This is good. It's moving in the right direction. There is some technical challenges that we can discuss now. Back to normal 2028, I mean, who knows? Here, the timing, as value investor, I don't know when this thing will be back. What I know is that in 2026, the margins will be around 20, 21% EBIT margin, and that next year, they will lose like 10 points, more or less. I'm not the one that is going to target exactly what is going to be the EPS and the PE. Okay, we will see this year a good profit, good cash flow next year, lower, and then what they say is that platinum plating will take kind of 2 years to be implemented. It's not a huge investment because they have the skills, the expertise with gold plating. They do also rhodium plating, and they have been testing platinum plating. You need to take the word of the management here. But looks like what they say is that this is feasible in 2 years. The foundation is good. So this is what makes us so sure on the investment case. Strong brand, which I think we proved. Asset light, return on capital employed on normalized markets is 40%, 40, for these guys, which means that they have their assets in Thailand, but they don't need to reinvest that much. Now they are growing the capacity by 50%, 50, in Vietnam. This is, why do they increase 50% the capacity? So they should be really sure that they're going to grow in the future. Growth opportunities in low penetration markets are evident, so I don't discuss this. The sector normally grows 3-4% organic growth. I'm using 5, so I don't think I'm going to be very wrong here. Okay, sustainability, they are top standard, and the financial ambition, their financial ambition is a high single-digit growth top line, and margins 21, 22, I think is the guidance, 23. 6-7 years ago, their margins were 30%. And now the guidance, I think it's very reasonable at 21, 22. So in our opinion, yes, they're going to be back to normal in 28. I may be wrong, and they are back in 2029. We don't care. We will probably double our money here if things go the normal way. Obviously, we are investing in businesses, and there is risk. This is why we diversify the portfolio. Then they have some options, lab-grown diamonds by Pandora, so I like it a lot. It's, half price of a natural diamond. They are growing a lot. They are killing the industry. Even the natural industry is claiming for, you need to brand that is lab-grown, that is really natural. But in the end, it's going to be very difficult to stop this because you get the same, more or less, okay? I'm not an expert in diamonds, and never will be. But you get the same thing for half price. Valuation, price around 600 Danish krona, PE 8.5, normalized PE. We normalize earnings, and we normalize earnings everywhere with commodities or with everything. So I take these 20% margins. Free cash flow yield is amazing. So free cash flow, from memory, 2 years ago was 6 billion kronas. Last year was 5.5 billion kronas. This year will be more or less the same because they are hedged. Next year it will be half. But they are not in negative free cash flow, so they are free cash flow producer. Our discounted cash flow model, 1,400 intrinsic value, using 5% growth, 22% EBIT margin, ROIC 30%, so a bit lower than the average. And the most important thing, the numbers are really, the important thing here is if we are right with our analysis that this is a good business with high entry barriers and cost advantage and blah, blah, if the management is not going to lie to us and then platinum plating can be done and then the thing can be done, the restructuring, balance sheet is good, I have no doubt there, and then good price is down like 60%. So it looks like we have a good price. And this is our long-term partnership call that I was trying to explain before. We like the long term and we look for partners. In the companies we invest, and if you invest in us, it's not going to be for a quarter. We are looking for husbands and wives. This is marriage. We are not doing things, we are not building a business for 3 months.
It's artificial diamond.
So here you can see that we've been in Pandora since 2016, so 10 years. We never sell at the high, we never buy at the low. But on average, we've been correct in these 10 years, and now we are building more and more. And if the stock goes down, we will more of Pandora. We will buy more of Pandora. That's it. Thank you very much.
Thank you very much. You know, some years ago we were also invested in Pandora. You also like the company. And I guess it's similar on your side. When we start looking at a company for the first time, we start looking backwards. So what have they done? And Pandora is an amazing cash machine. And something you haven't mentioned, they bought back like 25% of shares in the last few years. So that is the past. Right now, you touched on that, they are, I guess, in the biggest turnaround, transition, change of their business model ever. We've got a new management, a new CEO coming in. We've got a star manager who has just left. And from majority solid silver, sterling silver products, moving to platinum plated. How do you handle this? How do you handle this change?
Well, in my opinion, that is my opinion. So basically, we know the company. And the 4Gs, when we say good business, good managers, good balance sheet, and good price, we think they are there. So when I speak to them, I trust them because they earn my trust over the years, over a decade. So in my opinion, the change of management is not radical, it's continuity. And Alexander is going to be there for help at least in the next couple of years. And the lady looks, Berta de Pablos, looks really experienced. And from the beginning, the first meetings, she looks very focused. So that's good for the management. Then in my opinion, the change in the business is not that radical. So basically, they are late with taking, from solid silver to plating platinum. I think it's not radical. So you are diversifying your cost. You should have it done earlier. You should even do it more. Rhodium or other metals, and try really not to depend on one commodity because we know the commodities. And from what they say, technically it is possible. It is challenging, but from 1 to 10, my number would be 6 in terms of challenging. And they say that they have been testing it and that they have a lot of experience with gold. It's not the same because of different aspects, but it looks good. And then in terms of design and assortment, I think it's a slow change. I don't think really you lose, because it's a generic product. It's a bracelet with a charm. 2,000 years ago, they were using bracelets and charms. So, I mean, they're not going to lose this. It's a matter of just finding the right design in this collection. And then if this doesn't work, you launch another collection with this metal and this aspect. So I think, in my opinion, that the business is not changing that dramatically.
You mentioned your partnership. You are with the company now for 10 years, I guess, with Pandora. If you hadn't that experience, would you buy it today?
Oof, a very good question. I would do a much more effort in understanding what is going on. So to really buy into if you read, and everybody here reads the value investors and Warren and Charlie, normally they say don't get into restructurings. Yeah. Don't get into restructurings because it's too complicated. But so if this starts now, I would really spend maybe 2 or 3 years talking to them and then to the experts, and then is platinum plating working, is this blah, blah. Yeah. But once, maybe it's a problem, because I was thinking maybe I'm not digging in detail here and there, but when you trust the management that has told you for 10 years and everything they say has been even conservative, I think you can move to a more, let's say, fast track.
Something else, if you come to Pandora for the first time to the shares, and you look at the performance chart in the past like you've shown, I mean, earlier on this morning you said boring is good. This share price is not boring. I mean, there are 3 times the shares more than quadrupled and came back down again. I mean, what's going on there? This is not a tech company.
Right, no, you're right. I mean, it's kind of surprising because the business model, in our view, is so good. They shouldn't do these things. But they did a big mistake, I don't know, 12 years ago in the first fall, because they tried to move into the watch industry, which is not easy to compete. So they moved to watches, and they completely screwed up with, everything. So then it went very bad, first cycle. The second cycle was a cycle of a bad management, in my opinion, because I had a one-on-one, the CEO, like this, and he lied to me for 1 hour. Amazing. So all the inventory is full of crap that they should mark down, IT systems that, I asked the question because we know Inditex. Inditex is the textile company in Spain. They are super good in the IT, so I was checking, and they told me, in Inditex, they told me, well, be careful because the IT system. And I asked the CEO, how's your IT system? Do you really know where the inventories are here, there? Also, the model was different, more wholesale, more franchises. But he was lying, so they were not selling because they were out of fashion or what they were filling the channel. Well, so this CEO left. This was the second one, and then Alexander came. And this Alexander, we learned the other day that you have funds out there that follow the top managers, and they invest. Where they find a top manager, they follow him. So my advice here is find where Alexander Lachik will go, because he's really outstanding. So, but you have, let me go back to NVIDIA, because I was there and I wanted to also to speak. NVIDIA is like Ryanair, is like Pandora, what I call cyclical compounders. Compounders is companies that are able to grow, but they have cycles. So it's a good investment long term because you have the growth, but like semiconductors, no? Big investment cycle, then prices will go down. Then the semiconductor cycle usually is 2-3 years time, is very short. We were very close to invest in Micron, Hynix, and these guys, but we were thinking it's 2 years, it's too short. Pandora cycles look like are higher, and in Ryanair, cycles are also 5-6 years. So we like these names where you think that the business is good enough to be there when they fuck up a little bit.
Marcus, thank you. I reserved the toughest question for the end. As a value investor, you are contrarian, like we all are. I'd be curious to know who will win the World Cup.
Very good question. I was told that Spain is I'm from Spain, obviously, and Spain is one of the top guys, but I would bet on maybe France.
It's not that contrarian, but okay. Thank you. Thank you. We talked about charms, like these, and I would like to convince you the next few minutes that this thing can have its charm as well. Before we get into this, just a very quick reminder of what we do at BWM. We focus on normalized numbers in any environment. So one thing is we try to estimate, calculate what's the normalized earnings power of a company. We want to know what's the normalized valuation that the company would deserve. And multiplying the two gives us our fair value estimate. And usually we assume in 3 years everything is normal. So this gives us the fair value in 3 years' time. We discount that back to today, gives us the current valuation, the current fair price. And we then, of course, back that up also with a discounted cash flow model. And we don't only look at a fair value as a pinpoint, but more as a range. So we do also calculations on certain scenarios. What could go worse than we expected? Might we have been too conservative? With that in mind, let's look at Wienerberger. As the name suggests, that's an Austrian company headquartered in Vienna. They are the world's largest producer of bricks. They operate in 28 countries, that's in Northern America, and here in Europe, basically everywhere except Switzerland. They have more than 200 production sites, more than 20,000 employees, and keep that in mind for later on. The market cap is around about 2.5 billion, a little less than 2.5 billion. The portfolio, what they're selling, what they're producing, covers all kinds of bricks for roofs, wall, facade, surface. They have some water management pipes, and they also have photovoltaic solutions for their roof segment. Can it get any more boring than this? Look at this brick. Can it get any more boring? Well, can it? Let's take a look at the share price over the last more than 2 decades. During the financial crisis, the shares went down by 90%. So the business isn't that boring after all, I guess. We need to understand, can this happen again? What has changed, if anything has changed? We are, again, like in those times, in a recessionary environment on the construction side. Here you see numbers for new housing construction starts in the US. You see this decline during the financial crisis. You saw the recovery thereafter. And the last 4 or 5 years, we are in a declining direction. And again, this year, we are also trending downwards. Let's move over to our side of the pond. This is Germany. New residential building permits, which is a leading indicator for residential buildings. You see the same decline as in the US during the financial crisis, hardly any recovery thereafter. And now for 3 years, and currently we are in the 4th year, where new construction has basically come to a standstill or close to a standstill in Germany. So market aren't looking good for Wienerberger. We can look at those numbers for any kind of market where they're in. Nice enough, the company does that for us. Here you see an index that Wienerberger calculates and publishes themselves. They look at all the markets they're in, all the verticals they're in, and looking at the market volume, and they set 2021 as the base year, as a reference year at 100%. Last year we were down, volumes were down 35% versus 2021. And we are not seeing a recovery this year, so likely we will stay at this minus 35%. For us, it's important, we know it's a cyclical industry, but with those kind of numbers, we are pretty sure that we are closer to the trough than to the peak. So if at all, we would regard this as a positive picture that eventually there should be a recovery coming. Now let's look at the financials. How's the company faring in those dire markets? Here you see operating profit margins, that's EBITDA. Yes, it has come down a bit over the last few years, but it's holding up pretty well. The company is solidly profitable even in those environments. Different perspective on the same point, free cash flow generation. They are easily profitable, they're making a bunch of money even in those markets. And here you see our forecast for the next few years. And the dip this year is basically technicality. There is a normalization of net working capital. So the numbers thereafter, this is the underlying free cash flow generation. And this is not assuming recovery. So again, keep in mind, we talked about a market cap of 2.5 billion. The company is making 250 to 300 million in free cash flow. How was that possible? What has changed since the financial crisis? In 2007, right before the financial crisis hit, Wienerberger was making 95% of the revenues from the new build segment. That is by far the riskiest and most cyclical end market. Last year, that was just 45% of revenues. And in the meantime, organically and through acquisitions, they have grown their exposure to renovation, that's mainly roofing, and infrastructure, that is mainly water management and piping. Those areas are much more stable over time, and they're also right now holding up much better than the new build. Another thing very important for us, we're looking at the balance sheet. Here you see the leverage ratio, net debt EBITDA over the last 22 years. The company had already some leverage before they entered into the great financial crisis. And then leverage skyrocketed. That's the time when the current CEO took over. He had to do a capital raise. He had to issue 2 or 3 expensive hybrid bonds, which are all paid back now. But ever since, the whole company basically in their DNA had this near-death experience. And they were focusing on stabilizing the business, making revenues and profits less cyclical, more stable, and delevering over time. So the current crisis was entered with a leverage ratio, a very strong balance sheet of less than 1 times. Now, going forward, what's the earnings power of the company? Here you see in absolute numbers the operating profit over the last 20-some years. And this year, management in their guidance talk has basically given up. They have thrown in the towel. They are no longer talking about any recovery. They are guiding for an EBITDA increase based on no recovery in end markets. This is only the latest 2 acquisitions they've done that will flow into EBITDA, into profit this year, and then also more next year. And certain self-help measures, some cost cutting, some getting more efficient, closing down some plants that are underutilized or mothballing them to be opened later on when the recovery comes. Now, despite being closer to the trough of the cycle than anywhere else, despite a better balance sheet, better quality operations, better quality portfolio, more stable, despite all of that, the company is trading very cheaply today, both on an absolute level as well as on a relatively level with the history. This is enterprise value to EBITDA, a little more simplistic. We can look at the price earnings number. Wienerberger is trading at less than 11 times earnings this year, less than 9.5, I think it's around 9 times earnings next year. They're trading at a free cash flow yield for the next few years of 12, 13, 14%. So even if no recovery is coming, the shares are too cheap today. And obviously, I'm coming to the end here, that's the reason why we own them in our funds. Here you see over the last 4 years the share price performance. The red bars show you when we bought and when we sold a few shares because the stock got too big in our portfolio. And the green line, that's this baseline, the pin value for our fair valuation. And the yellow lines show you the range that we are seeing where the fair value should be. The latest decline in the fair value, that is basically us also assuming the recovery will take a little longer to materialize. So there's upside to all of this if eventually the recovery comes. My last slide, very quickly, those are the 2 funds that we manage. They are very similar. The subtle difference, there are subtle differences, but the main difference is in the 4th line. The classic value can only invest in large cap stocks defined as larger than 2 billion Swiss francs when we buy them for the first time. Now, Wienerberger was larger than that, so we own Wienerberger in both of our funds. With that, thank you very much. Easy on me, please.
Very interesting, and clearly a commodity stock, so appealing to me as well. This is just a brick, and they're the world's largest producer of bricks. So what do they do differently than anybody else in the world? What makes them so special? Is it a better product? Is that possible, or is it better service?
I love boring, so it's a boring industry, I understand that. But when you dig deeper into it, it's not that boring. Actually, the important point on Wienerberger and on the investment case is the pure fact that they are the largest producer. Large meaning those more than 200 production sites. Bricks are incredibly cheap relative to the weight, so they don't travel far. It's similar to cement. You have a certain strong market position around your production site, and most of their competitors operate 1 or 2 sites. So when the recession hits, they cannot close them down. They have to produce or give up. And there are certain small players that had to give up. Wienerberger is operating a network of production sites. They can close certain sites, mothball them when the utility is too low, and they can deliver to those markets from adjacent production sites, or also before they mothball it, they produce on inventory so they can deliver for a certain time period. That is, I guess, one of the most important moats they have versus competition.
Thank you. Well, and in a sense, you're talking about management quality, I understand. And when you, on one of your charts here, you were talking about how, even as their profitability was declining, they were able to maintain their margins. And we're just what is your sense of the quality of management overall, that they're pulling different levers? And
No, as I said, the CEO was already part of the management team before the great financial crisis hit, but he was not the CEO then. But he saw what went wrong, and he had to take over in the most dire of situations. Company was close to bankruptcy. And I think it says huge about him and his quality and the leadership that he's pulling after him, what they had done in the next 15 years. Basically totally turning the company around, investing in more stable parts of the business, and the numbers show that.
Terrific, thanks. And then just finally, there's much talk today about molecules versus bytes and tangible assets versus AI assets. And in particular, we've read these reports called HALO. Heavy assets means that they're very low obsolescence. So that's a good thing as an investor. So what's your thought in terms of your stock?
I have difficulties with technology. Very often I don't understand it. This is much more simple. And whatever we are going to do, whatever happens with AI, in the end of the day, when we go home, we need a home. We need to sleep somewhere. We need shelter. Now we can talk about, should that be concrete or clay bricks or wooden structures? That's also a different interesting topic. But in the end, we need those. Whatever happens. I like that.
Now, this is the perfect ending to this kind of conference. Thank you very much.